Joining us now is Dan Clifton, Strategas Securities Head of Policy Research. Welcome, Dan.
Hi, thanks for having me.
Let's talk about the 14% figure. I think that's
Yep.
a good way of thinking about this. You guys have some good work on this.
Yeah, so we went back in time and we said, what's the debt servicing cost of the U.S. government? And when the debt servicing cost hits 14% of tax revenue, we move into a period of austerity. So we were there from 1981 all the way to 1994. We have not been there since 1994. So we have low inflation, low interest rates, low debt servicing costs. We were allowed to cut taxes and increase spending, and it didn't increase any of the burden. Now we have that rising interest cost because we had inflation. The debt ceiling is really just the opening course for what's going to be a longer period of austerity. We're at about 12% of interest costs of tax revenue. We'll be at 14% by the end of the year. And so that's a challenge for our policymakers. How do you avoid a default, but at the same time start getting our debt trajectory in a better place so we start coming out of this austerity?
So you have the situation where rollover debt is going to be have to pay a lot more, so that raises the servicing cost on the debt. How do you then avoid that austerity? Or if you have that austerity, what does the austerity look like? What does it mean?
Absolutely. I think that we're in the first course. So what we're trying to do is get economic growth as high as you can. The best way to do it is grow your way out of it.
But
you know, we're not going to be able to do that.
Yeah.
And so as we talk about the debt ceiling, we're probably going to have a deal that starts to limit discretionary spending, starts to get rid of the unobligated COVID fund. This is the low-hanging fruit of Washington. Okay. What's happened now is that we have two trust funds that are now going to be exhausted in the next 10-year window. That hasn't happened since 1981. So you're going to have larger reforms. In 1981, we saved Social Security by making sure that we raise taxes and cut benefits. And that's eventually where we're going to have to go. But we won't be going there until after the 2024 presidential election, and there's more of an emergency.
The bad news about what you're saying is that we are not going to be able to cut tax. Like, we have a double whammy coming. We had double stimulus in 2021.
Yep.
Now we're seeing both the Fed tightening and tax hikes in order to fund these deficits that are worsening because of Fed hikes. So we can all sit here and wonder, well, then what's the cushion or the stimulus going to be if the economy starts to worsen? Because the picture you're painting isn't a great one.
That's right. And so let me just give you this point. In 2025, all of the Trump tax cuts expire. Income tax rates, estate tax rates, the state and local tax deduction comes back in. So there's an automatic catalyst built into the system. And that will be the big market issue for 2025. We're going to hobble along until we get to the election, get the debt ceiling out of the way, and then maybe we'll do a little bit on the child tax credit just to make families feel better ahead of the election, maybe something on the corporate R&D. But once we get into 2025, I don't know who would want to be president in the next administration, because these are challenges we haven't faced in 40 years, and we're going to have to deal with these challenges.
Does a debt ceiling raise or suspending the debt ceiling, does that happen before the X date?
Well, I think it's going to happen right at the end of the deadline, right? So we'll do it. And we may even do two parts, where we get a spending framework agreement by June 1st, raise the debt ceiling for 6 months, and then try and fill in the details of that agreement by the end of the year. I think the real big one for markets will be this first one, because the president's dug in, the speaker's dug in.
Is there a way to engineer it so that President Biden, who has said, I want a clean debt ceiling raise, I don't want it tied to spending cuts, is there a way to make that happen?
I think the two-step process does that, where you're making it more about the budget and not the debt ceiling. And Speaker McCarthy is still getting his
So there's a wink
cuts.
deal, basically.
It's a wink-wink. That's right.
We agree we're going to do some spending cuts here, but it's going to be separate.
Yep. I don't care how we get there. I just want to get there, right? So, but, you know, they're going to have to figure out a way to save face. The policy is actually kind of simple once you get into the arena.
What do you think is going to happen with deposit insurance?
So I'm conflicted on deposit insurance. If you remember in 2008, Sheila Bair was able to unilaterally exempt all the payroll accounts at the banks.
Was she?
Yes, she did. And she did it by executive action. Dodd-Frank now says Congress has to be involved in that process. There's no support for raising deposit insurance limit right now in Congress.
Even for payroll accounts?
Even for payroll accounts, because on Monday morning, Washington thought the banking issues were solved with First Republic Bank. What we're learning is that it's not solved. This is going to be ongoing. And so as these banking issues continue to grow and there's some risk to employers on their payroll and to insurers, individuals on their deposits, I think you'll start to see some more steam for at least gradually lifting it. What we're doing today, having large banks buy regionals, is not exactly a sustainable strategy over the long term.
Especially when JP Morgan's already done a deal.